Guess what? There's a shift happening in the housing market. There's 47% more sellers than buyers. And at the same time, you might not know this, but it's making FHA loans easier to use. Now, if you're an FHA buyer, you've probably had this exact thought. Why does it even matter to the sellers what loan I use? FHA, conventional, or whatever, right? At the end of the day, the seller just wants their money, right? And that makes sense. But it's usually not the sellers who cares, it's the agent representing the seller. And here's the truth. Those real estate agents might have had a bad experience with FHA as weak buyers, unqualified, or no money. And that's what I want to break down today. Like, how is this market shift actually turning FHA from a liability into an asset? So if you're thinking about buying in the next year with an FHA loan, this video is going to help you understand when it works and when it doesn't, and how to use it the right way so that way you can win in 2026. And again, this isn't theory. I've helped over 500 families get mortgages, so I've seen it all. All right, so let's jump right into what is FHA's superpowers, and then we're going to talk about when not to use it. All right, before we talk about FHA's superpower, we have to talk about why is FHA a weaker offer? And the reason for that is because FHA has more requirements for the appraisal. So meaning it's more strict, and like if the house needs repairs, sometimes the appraisal doesn't pass. So if you had a property that was kind of like on the edge of like, hey, you kind of need to renovate it, you kind of don't, FHA may not be a good option because of that strict appraisal where there's all these other offers on the table, right? So why would the listing agent want to choose the harder offer to close? And that's where the market shift comes into play, where there's more sellers than buyers. Meaning if you're a home buyer, there's multiple houses that you can look for, right? We're back in 2020 and 2021, when rates were like 3% and 2%, there was like one seller and then 50 buyers trying to bid on the same property, right? So going with FHA in that situation would have been much harder to pull off. But like I said, because of that shift, it's becoming a little easier to get the offer accepted. And that's why with an FHA loan, it's more about the appraisal, and that's what the listing agents are worried about. All right, let's shift gears to what are FHA's superpowers. So when people hear FHA, they think, low down payment and low credit score. So yes, that is a real superpower for sure. You can literally put 3.5% down, which is amazing. And you can qualify with a 580 credit score. Now, am I saying that's the best thing to do to have that credit score and buy? Not necessarily, but you can technically do it. But this is where it actually gets more interesting. And I would say this is the superpower that a lot of people don't talk about. It's that seller credits will allow you to go up to 6% of the sales price with an FHA loan. Now you might be wondering, what are seller credits? Seller credits are like coupons for your closing costs and other benefits to help like lower your monthly payment. So if you're buying a $500,000 home and 6% of that purchase price is $30,000, like let that sink in. That's an amazing amount, which you can do with FHA. So here's how it works. All right, so I got a little secret for you guys. I made a homebuyer readiness quiz. It's completely free. It takes less than a minute to find out how ready you are. And even if you aren't ready, I give you personalized videos on how to go from like a C to a B to an A, and it's all completely free. I spent over 100 hours like editing it, cutting it down, making the tools, stuff like that. I think it's gonna help you because this is something that I wish I would have had when I was buying a home. I wanted to know how ready I was. So if you're interested, click the link down below. It's completely free. I hope it helps you. Back to the video. And this is where that market shift really matters, because we're in more of a buyer's market right now, meaning buyers have more leverage again. So this was not like a thing in 2020 and 2021 where you could get 6% in seller credits, right? Because there's so many other offers on the table, the seller's gonna accept the one where they make the most amount of money, right? Because if the sellers give you seller credits, they're gonna make less technically, right? But obviously it'd be benefit for you, right? So that's where that shift comes into play. And now this is where it gets really interesting, is we can pair that extra seller credits, right, up to 6% of the purchase price. So I'll give you an easy example. So let's say we're gonna do what's called a 2-1 temporary rate buydown or 2-1 temporary rate buydown. Let's say your rate is 5.5% for FHA. So usually, by the way, FHA rates are about 0.5% lower than conventional loans. So year one, with the 2-year buydown, what's gonna happen is your interest rate will be 2% less the first year. So it's gonna be at 3.5%. So 5.5% all the way down to 3.5%. Year two, it's gonna go up to 4.5%, so still lower than 5.5%. And then year three and beyond, it stays at that 5.5%. So you get 2 years of lower payments. And that would obviously be super helpful for you to maybe get settled in, furnish the house, and then maybe wait for a refinance opportunity. opportunity. Now, this isn't because like FHA suddenly changed its rules where it allowed all this stuff, right? It's more because of the market shift where buyers have more leverage again. And I remember in 2020 and 2021, like people were having to like offer their dog and their kids of like, hey, just take my kids for collateral while we're doing our due diligence. That was obviously more of a seller's market, right? But now it's like buyers can be more picky. And this window will not last forever. So please like this video. Well, yeah, to like it, but you can always come back to it as well, because I promise you that this buyer's market, this small window of opportunity for FHA buyers will not last forever. Meaning we can't be getting these crazy seller credits. And at some point it will shift to a seller's market again. So now that's FHA Superpower number 1. I wonder, can there be more? Yes. So there's more to FHA. And I don't know if you heard about this, it's the FHA 203K. Okay, meaning with the FHA 203K, you can buy the home and roll in the renovations into one loan. Okay, so meaning if you want to build the kitchen or renovate the kitchen, the bathrooms, the flooring, you don't have to come out of pocket. You can, bake it right into the first mortgage. So you could put 3.5% down, get your closing costs covered, right? Because with Superpower number 1, you can get up to 6% in seller credits, renovate the kitchen or the bathroom without needing an extra like $30,000 in cash. Now, here's the part that matters though. With an FHA 203K, right, there's a limited versus a full 203K. Now, anyone watching this, please take this and try your best to get the 203K limited. The reason why is, again, you get up to $35,000 in repairs, and it's way more streamlined and faster and fewer people involved, meaning you're not gonna have to get all these other people involved. Like with the standard, you have to get a HUD consultant, they have to approve the budget and then communicate with the lender. And of course, the HUD consultant's gonna cost money and do all this stuff. Now, obviously, if you have a bid and you wanna do the 203K and it's like 100 grand, yeah, probably the full 203K will probably be the better choice. But if you're like at 30,000, 35, 40,000, definitely try your best opportunity and try your best shot to get the FHA 203K limited, because you're gonna thank me with the limited amount of documentation you're gonna need. So again, I wanted to tie it back to why this is a great situation for someone who's wanting to use the FHA loan, is because yes, the FHA 203K, guess what? The fact that you have to, build in the renovation costs into the loan, it does take extra time, even the limited versus the full, right? One of the families that we were helping wanted to do the FHA 203K. And fortunately, this house was, like when a house is really priced really well for like a flipper, right? They're gonna pick it up because if it's a great deal, they're gonna buy it all cash. You don't have to do all this due diligence, and they're gonna flip it, meaning they're gonna buy it for like 400,000, sell it for 800, right? Put 100 grand into it. But this property was a little unique because it was above what a flipper would pay for, but too much work, I would say, that a regular like person would wanna buy, right? So is that just in that perfect sweet spot? But here's the thing, that 203K limited takes about 30 to 45 days to close, even though it's limited, right? Now, yes, you can do it faster, but don't sign up for failure. Shoot for 30 to 45. A regular FHA loan, at least for what we can do, is as fast as 14 days. You can close fast as 14 days. And we did one as 10 days, but I don't like to advertise that like crazy because, there's some things that aligned really well. But imagine if you could close in 14 days and compete with cash, where the limited, you could have to do 30 to 45 days, right? It makes it less competitive. But because of that market shift, right, there's less buyers in the market, you have that opportunity in this small window. All right, so I talked about the pretty stuff about FHA, but what's the, not so good? And what's the dark side of FHA and when I wouldn't use it? Because like with most things in life, there's always gonna be trade-offs. So what are they? So this is when I get nervous about using FHA, is when the property needs a lot of repairs, but you're not doing a 203K. Because again, FHA is definitely stricter with property conditions. And that's where, again, the deal could fall apart because there has to be repairs done before you actually close on the home. So I'll give you an example. Recently, actually, probably like 3 weeks ago from when I was recording this, there was a garage that the client was purchasing, and then, not the garage, excuse me. They was buying a house, of course, but there was a garage. And the garage wasn't finished, meaning there was like conduit and Romex being exposed, like the electrical wires and stuff like that. So obviously, if it's dark at night, you accidentally like flip the wrong switch, you can get electrocuted, right? So conventional loans, totally cool. you don't need to get that repaired, but FHA and VA loans, basically government loans, you need to get that repaired, right? That's part of the job. Now, if you're a seller, you're like, wait a minute, I don't want to do all this work before I sell. Like that seems inconvenient. But on the buyer side, you want it to be safe, right? So it causes all this friction, right? Now, if the seller was like, hey, well, there's 14 other offers, so go kick rocks. I'm not going to repair this. They're going to go tell you to kick rocks, right? And then you can't get the house. But we were able to pull that off because guess what? There was like no other offers on the table. So the seller was like, hey guys, I'll do whatever you want. Like, let's get this done, right? And again, in 2020, 2021, like the sellers for sure would have just not have entertained it at all, right? So that's an example of why this little small window is actually helping a lot of home buyers using FHA. So the other downside with FHA is the fact that there's an upfront mortgage insurance premium. They call it the UFMIP. I swear to God it is. Lenders like to use acronyms and confuse home buyers. It's just an upfront cost you put into a loan that actually allows you to have more flexible credit and a lower interest rate. Okay, that's really all it is. So the FHA upfront mortgage insurance premium is 1.75% loan amount, and then it gets added on to the loan. So I'll give you an easy example, just keep the math simple. This isn't a math class, but let's say it's a $500,000 house, 3.5% down. Your base loan amount is going to be about $482,000 roughly. And then you're going to take 1.75% of that $482,000. That's probably going to be around $8,000, but that gets added onto your loan. So now you're working with about $490,000 and change, right? Other math right over here. So just let that sink in, meaning you put 3.5% down, but you own less of the house. So there are some trade-offs with FHA, meaning you're not gonna own more of the house because you're gonna start off like a little behind. But there are, like I said, maybe the benefits outweigh the weaknesses, right? So that's where I wanna switch gears into later on. I wanna talk about that, where FHA might not be the forever loan, it might be the acquisition loan. So before we get into that, there's also another weakness, and that's FHA plus down payment assistance. And I would consider this a trap. Now, this is where buyers think that this is a great idea. It sounds great on paper, right? Everyone's talking about, hey, first-time home buyers, you're gonna get all these benefits, down payment assistance, grants, all this good stuff, free money, right? There's no such thing as free money, by the way. So when you pair FHA, because of that upfront mortgage insurance premium and down payment assistance, where it helps for the down payment or closing costs, right? What happens is you sometimes add on top of the loan. So you're going 96.5%, then 1.75% on there. Now you're borrowing 3.5%. So you're negative in equity. Sounds great on paper when you come into the deal with zero out of pocket, right? But again, you own zero equity of the house. So you're living in the house, but you don't really own any of it yet. So why this matters is because of the shift, right? So why is the shift happening? Meaning, why is there more sellers than buyers? It's because interest rates are so high. And when interest rates are so high compared to the 10-year treasury, all this fancy stuff, right? Mortgage rates are gonna come down at some point, right? Meaning, if we got interest rates a year ago, 2 years ago, guess what? In 24 and 25, rates have come down since then, in 2026, right? So when we go to refinance, those clients that did the FHA and down payment assistance, who have zero equity, they can't get out of it, meaning they have to pay this higher 7.5% interest rate. And guess what? Now it's like for FHA, it's 5.5%, even lower than that sometimes, depending on credit score. But unfortunately, they're stuck in that loan for much longer because we're in this market slower, right? The home values aren't increasing enough to get out of the loan, right? So that's where you do get in that sticky situation. And unfortunately, I saw this happen to a client that was referred to me. I didn't help them with the purchase, but unfortunately, they purchased, and what they wanted to do was they used down payment assistance to cover their closing costs, right? They had the down payment and stuff like that. And yeah, unfortunately, I think their rate was like 7.5% when I met them, which is crazy because come to find out, when I was talking to her and her family, right? She was like, I asked her, I was like, hey, what made you go through this? Like, what made you, choose this option versus that? Because again, I was trying to help her refinance when I was referred to her by another past client. And she was like, oh yeah, the reason why I did this was because I didn't have enough for the closing costs, right? So she had the money for the down payment, but she was using down payment assistance or like a grant for the closing cost. And I was like, oh no. Unfortunately, the real estate agent and the lender didn't advise, like, we can try to get the seller credits to cover your closing costs. We can have the sellers cover your closing costs, right? So in that situation, we could have, like, if I could turn back time, we should have asked for 10 to 15 grand in seller credits to cover the closing costs, because she bought in a market that wasn't crazy, right? Hence why the values haven't changed in 2 years, right? It wasn't a crazy market. So in that situation, unfortunately, that's where bad advice didn't help her. So she couldn't exit that loan and she could not refinance. So I don't want to be all doom and gloom because there are some pros and cons with FHA, like I mentioned, but more importantly, it's actually how you use FHA and who you have like kind of walking you through the pros and cons, right? So I wanted to give you like big picture stuff. So we talked about the tactics, the tackling and grappling and mechanics of FHA, the good and the bad. But I wanted to zoom out kind of like strategy wise to kind of give you some insight on if I were in someone's situation to use FHA, I would think of FHA more as a acquisition loan, not a forever loan, right? It's not gonna be your forever loan because it's just gonna be the starting point. So especially in a market like this, you wanna use that to your advantage as much as possible, right? Again, you're not using FHA because it's perfect. You're choosing it because it helps you acquire the asset first. And yes, we're gonna request those seller credits so we can do a 2-year buy down, etc., and lower our payment for the first 2 years, things like that, right? And usually with FHA, you might be using it because you might have lower credit. So, whenever I'm recommending something like this is like, we have to give the client a plan after they buy on how to get their credit up, right? So what happens a lot of times on the mortgage side is people will get FHA, right? And then the mortgage person will just like, congratulations, peace. Like, whoa, FHA is a temporary loan, right? Yes, we got the temporary rate buy down, we negotiated, we closed fast, we did all this fancy stuff, but we're gonna use FHA to refinance into conventional, again, assuming you're gonna stay in the house for a while, right? But in the meantime, we need to start working on the credit so we can switch to conventional, right? So in the meantime, let's say your rate was at like 7% for FHA, something crazy, right? And rates drop, right? We can do what's called an FHA Streamline. So this is an underrated strategy with FHA. In FHA Streamline, guess what? It's pretty streamlined. So you don't need an appraisal. You don't need income documents. You still need a job, by the way. And you can typically get it done with a soft credit check. So you do not need a hard pull or anything like that. So those 3 things make the FHA Streamline super easy to work with. So you can even go from a 7%, do a streamline down to 6% or even 5.5%, right? Now you can wait and have that comfortable payment while your equity starts building. Once the market shifts, home values start creeping up a little bit, and then hopefully we work on your credit, and then you can refinance into conventional, remove your private mortgage insurance in an ideal situation, right? And guess what? You're gonna have better credit too, so you might get better rates as well, right? So that's like the big strategy picture that I would use FHA for. And this is why I love teaching this type of stuff, because like a lot of people talk about FHA loans, etc., like they're describing like a tool. This is a hammer, this is a screwdriver. I wanna show you, hey, this is how you build an engine for a car, right? For free in these videos, right? So that's the big strategy stuff. All right, so that's all I wanted to talk about FHA. Because of that shift, FHA, I think, is gonna be a strong superpower in 2026. And yes, there are some weaknesses to it, but again, you wanna look at it from the big picture, right? Does it fit into my acquisition plan and my building my credit plan, things like that? If it is, great solution. And use those superpowers, right? Like I mentioned, because it's not gonna last forever. And as always, I try to make the best videos in the mortgage education space. So if you like this video, give it a like, subscribe and comment, maybe what you wanna watch next. Also, I would recommend checking out this video right over here. YouTube's recommending it. You might like it. I'll catch you on the next one.